Now, traps. Taxes are heading higher, risk of market losses, annual inflation impact, personal health setbacks. Maybe not your health. It could be a family member's health. Suits and litigation. A lot of doctors as clients because Florida is a very protected asset state. Likely, arguably, to Texas, they're the top two. And this is where a lot of folks, for various reasons, but in particular those that have a lot more exposure to being named in a medical malpractice suit or what have you, insurance products are protected. Now, OJ is a very poor but good example of what I'm about to share with you. You know, all pensions are paid in some form from an annuity, which an annuity is an insurance product, right? And as a result of that, and on top of the fact that he has these special design insurance contracts, I've never worked with O.J. Simpson, but other people have. That's why he made his homestead in West Palm. Now he screwed that up. Evidently he has a new homestead in Arizona somewhere, but you all know the story there, likely if you followed that. But this is what I'm teaching you today, that middle world, that personal protected pension plan guards against these hidden wealth threats. No one plans on getting sued. My wife was at Publix, 2 years ago, and watched a guy try to fake his fall in one of the aisles. I mean, this is how sad our litigious society is. And evidently, there were a couple people in the aisle that were almost laughing like, that's as good as, wow, that was a really poor performance. No Academy Award there, right? So you got to guard against these things. So let's look at these. This is how simple this is. Tax me now. This is the tax threat, right? Taxed as earned. Now, if anybody cares to remember, in 2008, after a lot of us, if we're honest, suffered a loss, right, on that type of money, to rub insult to injury, right, got what? A tax bill after losing 30, 40, 50% of our account value. Why? Because the brokerage who turns over the portfolio isn't going to pay the tax for you and I. They're going to pass that on to Roy and Sonny and the rest of us. So, I mean, we had people calling up going, I'm not going to get one of those tax bills from you, right? Nope, your money grows tax deferred. And you didn't lose anything with us. That's the fascinating thing we try to share with people as they meet with us. You don't hear the phone ring very much in our office because there's nobody going hysterical about whatever happened in the market that day. It's kind of a sense of calm, which makes it a lot easier. I supported the top financial advisor in the country with a very recognizable name, and he would bring us in to be the specialist in this area. And it was fascinating. We had to reschedule a lot of the clients he was trying to refer during 2008 because he was fielding landmine calls. It's like, wow, Marty's got to reschedule again. Marty's got to reschedule again. And I finally said to him, I said, Marty, you got a lot of rescheduling. He said, you can't imagine the phone calls I'm getting. Oh, I can imagine the phone calls you're getting. At least you were man enough to answer the phone. Most of the people didn't even call you and I back. Tax me now. How about this one? Tax me later. Right? So if I said, Colleen, I've got a loan for you to consider. And you'd say, well, talk to me about the terms. Well, the terms are this. We're going to tell you when you can take your money out, and then there'll be a certain point in time that we're going to force you to pay the money back. And then at the time of that, you probably have the question of what we're going to charge you. At the time of when you start taking it out, then we'll let you know what we're going to charge you. How motivated are you to take that loan, Colleen? That's a 401k and an IRA. See, that's a 40% interest rate for most of us in this room. Maybe in Florida, that may be a stretch. Maybe it's a 20, 25% interest rate. None of us would borrow money at 20% in this room. I'm confident to say that. But the reality is you don't save money in those programs, folks. You defer the tax. No one ever told you were going to save the tax. You're deferring the tax. But what else are you deferring? The tax calculation, which is defined by whom? Us, right? I want to teach you this real quick, so write this one down. Ours, there's ours, right? O-U-R-S. And there's theirs, right? Now, theirs, I want you to be careful as you write it. T-H-I-R-S. So there's ours and the IRS, right? Today we're talking about yours, not theirs, okay? That's going to be the big difference as we go forward here. Last one is tax me never, the retirement insurance contract. Well, how can you say tax me never? What about estate tax? You know, they're fumbling around with this stepped up in basis that they may take away from us, right? Does everybody know what stepped up in basis means? When a family member of yours passes away and you inherit money from them, they may have had this much of a basis of the asset when they bought it, but at their death, they get a step up in basis of that value, so that maybe if they bought a stock that you inherited from them at $40 a share, but on their death it was valued at $100 a share, you inherit it at $100 a share, so that if you turn around and sell it, there won't be that nasty 15 to 20% capital gain. See, if they do away with that step up in basis, there's going to be a tax fiesta going on in this country as a result of that, right? So be careful. So not only that, but the estate tax exclusion. This is the big one. People are saying, well, yeah, it's hard to argue the tax bill when you're dead. Yeah, that's by design, right? That's Denmark Elephant Gray. It's hard to argue what you're going to... Joe Robbie didn't have much of a say in having to sell the stadium, did he? And unfortunately, that was the situation. Well, now they're talking about reducing that down, reducing that down, reducing that down. So how do you get around that? Okay, not giving you legal advice, but giving you perspective. It's called an ILIT, an irrevocable life insurance trust. So you don't have to own it in your name. You can own it in the trust's name. Doesn't mean you owe tax on it. It just means when you die, the value of the death benefit doesn't get counted in your taxable estate. Now, that's a little advanced for some people, but it's important. Don't build the castle if you're not going to build the moat. Why in the world would you set all this up to be taken advantage of later? That's an IRA and a 401k. That was its design. This is not that design. Taxes. What's the average tax rate been in this country since inception? Any guesses? 60%. People are like, no way. You promised to Ron that you would suspend your disbelief. No way it's been 60%. Yeah way. Yeah way. It's just been very, how would you say, cleverly manipulated. That would be a fair, politically correct use of terms, right? Anybody look at their cell phone bill, tax and regulation fees? That was the eye-opener for me. I was in a hurry before they were going to raise the contract with Verizon for the iPad. And I rushed out a few years ago in July before that deadline. I was so excited to lock in my $35 a month until I found out that the fees and the regulation fees were more than the $35 I paid for the service, right? It's like anything else. Those of you do the grocery shopping here, are costs going down to you? Isn't this fascinating? Every time I've asked somebody this, no one's ever substantiated any backing of our government that comes out with this ratio called, or this calculation called core inflation, right? Do you know what core inflation is? It's everything but food and energy, supposedly, and a lot of other things, but we don't have time to give you the names of those things. So here's what we're going to do in 2010 and 2011. We're just going to let you know inflation is so ridiculously low that there should be no reason why we'd have to increase your cost of living on your Social Security benefits. Now, you know that's being manipulated again, right? You've heard of CPI, the Consumer Price Index. Now they're going to do some type of indexing to the Consumer Price Index. So it's going to be like this formula that you're going to need to bring out some kind of PhD mathematician to say, well, wait a second, that just means they're going to pay me less. Here, I'll solve it for you. It just means they're going to not give you as many increases, if any increases at all. Why? Because they're broke. Why won't they tell you? Because, I don't know, they just don't tell you. They try to tell you every year when they used to spend the paper to send it to us on our birthday that says, by 2047, likely that these benefits could go away. And then it went down to 2037. And if you ever watch the fine print on that before, this is the first money savings agenda I've ever seen our government actually instill, is now you have to log on to the website. So they probably paid 15 companies to get bids on the website to go to, paid 4 of them, then decided on 1, right? Kind of like the government contract. Supposed to laugh at that, but there really isn't anything funny to it. So let's look at this, the risk world. This is the big one, investing. The 20-year average equity investor return done by a third-party auditor called the Dalbar study. Every March it comes out, reflecting on the prior 20 years. Average equity investor return, 4.25%. Now that could be taxed as earned, or it could be tax deferred, which means it really isn't 4.25%, and that's before fees and expenses. You know what the average fees and expenses are inside of a mutual fund? 2.37%. Now, Morningstar will tell you different. Wonder why. Who funds Morningstar? Oh, the mutual fund companies fund Morningstar in some capacity, right? Because the mutual fund companies have to buy the software. So you're never going to see this. They're going to tell you that the average fees in those accounts are 1.52%. Okay, let's say that they're 1.52%. What I'm showing you today is less than 1.5% after the advisor, the actuary, the underwriter, and the death benefit has been paid for. Less than the lowest Morningstar advertised management fees. Very important, if it's designed right. Now, here's another area, in fairness, that I would agree with some of the pundits on TV and radio, that life insurance is a horrible investment. In its traditional form, if you're looking at it as an investment, that's a factual statement. Unless you know how to design it as a retirement insurance contract, which most people don't know, so it's easier just to generalize and tell you that insurance is a horrible investment. The reality is insurance isn't an investment at all. It's a savings vehicle. It's never been an investment. It never will be an investment. And this should tell you the lack of understanding around what you're learning. Lastly, indexing. This is really, really key. Indexing, not investing. Huge contrast. So watch. Here is the father of indexing. We've all heard, as a show of hands to involve you, we're going to get you involved a little bit more here again. How many of you have heard of the S&P 500? Okay, good. Most recognized indice on the planet, right? John Bogle knew this, and at a commencement address at the University of Princeton, which he wasn't invited back after this, he said, don't pay somebody to underperform the market, just buy the market. Okay? And then he comes on CNBC, I think it was, April 1st, and says, prepare, look at this, prepare for at least 2 declines of up to 50% over the next decade. Now, I can't even imagine being a asset under management advisor to you and saying, Ray, I think we should prepare for at least 2 50% declines in the market over the next 10 years. What do you think? I would hope Roy would say, what's our game plan for that, right? Because most people have lost 50% 2 times in the last decade, okay? And that's caused them to not have really any net growth as a result of the ebbs and flows of the market. Amazing. But stick to cheap indexing funds. So if someone were to say to me, what is it you're teaching? I'm teaching you the Roth IRA with a floor of protection. Okay? We taught a group of business owners yesterday, so if you're a business owner, make sure we know it if you have an interest. There's ways that you can design this inside of your company. And then that's more of a 401k on steroids. So imagine getting a deduction to put the money into the plan, letting it grow without tax, being able to get it out without tax, and then transfer it without tax. Right? You could do that inside of a company. Now, those of us that maybe are retired or we don't have our company or we sold it to our kids or whatever may be going on, we have to fund it with after-tax money or we have to fund it with pre-tax money that we haven't gotten out of the ticking tax time bomb trap yet, which we'll show you how to do that in an example coming up. Arguably the most successful investor of all time, Warren Buffett. True? Anybody know Warren's number 1 rule for investing?
Don't pay your taxes.
Don't pay your taxes. Pay less tax than your secretary, right? Never lose money. Now, has Warren Buffett never lost money? He lost billions of money. He's lost billions of money, right? But here's what he just said. This was May 6th. We will have another bubble, and it will burst. So I really wanted to bring this to the forefront in May. I couldn't have timed this up any better. That in the last couple weeks to the last month, you've got 2 of the most recognized people in the investment arena that are telling you this is what's happening. You know his famous quote? Be greedy when others are fearful, and fearful when others are greedy. And I'm not trying to give you doom and gloom. I don't know that the market's not going to continue to rally and things will go well, but what I can tell you, at some point, the party's going to stop. And at some point, we'll go through this cycle again, and we'll go through the cycle again, and it's as predictable as Denmark elephant gray. It will happen. So, when do you think the Dow will go back to 22,000? This was a poll taken, and they asked people, and I'll ask you, for you to risk losing money, what's the minimum rate of return that you'd be willing to take that risk for? Anybody? What's the rate of return at least have to be before you're willing to risk losing money? What was it? 5%. The answer was actually 7. But watch. We ran the analysis at 5, and if it were 5, the Dow today would have to be at 22,000. We should already be at 22,000 if it actually has done 5%. were a far cry from 22,000. Although today I heard we're going to go to 60,000. So we better get in the market. Better log on Monday early. Time to retire the 401k. Watch how this works. This was 09, by the way. Time to retire the 401k. In fact, there was a quote that I thought we had that basically said it was a financial flop. It was a risky repository. It's time to do away with it. And I don't know if did anybody ever catch the interviews on 60 Minutes about this time in 09 when they actually interviewed people about how much they lost and what it meant and what the impact was and how they couldn't retire then, etc. Fascinating. I think you should be able to Google that or Bing it or whatever. But 60 Minutes 401k interview, amazing. Amazing. So here's indexing versus investing. Remember I said we come back to lock in and reset, okay? And with the liveliness of this group, we're going to go there right now, okay? So for you go at home, we're about to be stampeded here live, and I want to hold people at bay. So what? We're in the green here, okay? So this is the safe indexing solution. This is how the insurance company does it. So now we're going into the watch. We just lifted the face off of the watch. Here's 100,000, and we put it in, and the market went up 10%. So our new principal is locked in with that gain at 110. Now, the red is investing. So let's say the next year the market lost 10%. We stayed. We locked in, and we reset until the next gain. And then when the market went up 10%, we went up. And then when the market lost 10, we locked in, and we reset and went up again. Now, to play this out, if you can imagine this, the average mutual fund prospectus can advertise this performance at an average return of 10%. Now, that's a little odd. I had 100, and I ended up at 95. Let's see, the actual return I got, wow, I finished with less money, is an actual negative 4.9%. Now, here's the grill in the room. Do you and I live on average returns or actual returns? Actual returns. And it's about time that someone gave you actual, accurate information. Okay? Passionate about making sure you understand what's real and what's fictitious. This is fictitious. This is how Wall Street and Main Street seem to do so well, because if you can take a former governor of a very recognizable state to head a hedge fund and sit, of all things, in front of a Senate hearing when asked, how did you lose $1.2 billion? And he can say, I have no idea, and months later be running another hedge fund. This tells you everything you need to know about this deception. Okay? Now, this hasn't happened yet. Up 10, down 10, up 10, down 10. But could it happen? Heavens, yes, it could happen. Now, how does it work? Very important. Get the pens out, especially for you engineers that need to see the schematic of this. This is very simple, but this is how it works. Okay? We take our deposit. See, in our world, these aren't premiums. See, a premium is something that you pay to put in the least to cover the most. Our clients don't approach us this way. Our clients are finding out what's the most I can deposit for the least amount of death benefit I have to take so that the IRS stays out of my business. So here's our deposit, and we put it in, and here's what the insurance company does. It's so important that you track with this, because this takes care of everything else I'm going to teach you today. So today, the insurance company only needs $95,000 or 95% of our original deposit to put it into what they call their general account portfolio, otherwise known as their legal reserve account, to make sure that they can meet their legal reserve requirements when they're audited every quarter by the states that they're in, which is why there's never been a time in history, make sure you hear it, that a life insurance company has not ever failed financially their policyholder. Not one time. Can't say that about banks, bonds, or brokerage accounts. But we can say it about the safest asset class I'm teaching you today. Now, I didn't say that life insurance companies haven't failed. Arguably, I think 17 or 20 of them failed during the Great Depression when over half the U.S. banks failed, right? But when an insurance company fails, which you'll see later today, they don't fail to exist for their policyholder or their contract holder. They may fail to exist as a company name, and either the state becomes that custodian or another insurance company does. But watch, their legal reserve requirements today, because of the volume of what they trade and invest, and when I say trade, I mean they can't lend the same dollar out 20 times like a banker can. Okay? They can't let people margin their accounts up to 90% like a brokerage can. This is the sacred cow of an insurance company. Why? Today they're making 5.7%. Today, in this economy, right? What are the banks paying us? 20, 30, 50 basis points. If we lock our money up for 5 years, maybe we get 1.25, right? Watch. So where does the insurance company make money, Chuck? Because you guys aren't doing this for free, and surely the insurance companies, they've been around for well over 100 years, so clearly they're making money. They're making money two ways. Here's the first one. They're keeping about 70 basis points, some as high as 100 basis points on their general account portfolio. Okay? Most of them, it's going to be around 0.75%. Now, the company I'm going to reference, because they're here, has over 70 million customers, which means they get 70 million 70 basis points. Actually, I think they operate on about 80 basis points. That keeps the lights on, right? But they'll share 5% of their yield, because we know that they can grow their original deposit you and I put in back to 100, and so they're going to offer you and I today, the average carrier, about 5%. So you could say, wait a second, did I just hear you say I could put my money into a legal reserve insurance company and I could make 5% and designed right? I don't pay tax on the growth, I don't pay tax on the access. That is exactly what I told you. But we're in the lowest interest rate environment that our country arguably has maybe seen in 75 years. So is there another option? And this is where you'll know more than 99% of financial advisors, and for a fact, more than 99% of insurance agents, right here. Here's how they do it. We have the option to make 5% on our $100,000 deposit. Do you see that? Right? 5% of $100,000, $5,000. Are you with me? That creates an options budget of $5,000. Now, for some of you, just to keep it simple, there's what's called puts and calls. You've heard of trading options, right? So what an insurance company does, we don't do it, okay? You don't pick the options, right? You pick the index that you want to take the option on. Very important that you hear this, because this is so easy once you get this. So let's say you pick a basket of stocks like the S&P 500. Okay? You have that say. Every contract year, not calendar year, contract year. So let's say your contract year was on a business day yesterday, May the 17th. So from May 17 to May 17, that's your segment, like the prior screen that I showed you, right? So whatever happened between those 12 months, the insurance company is buying an option for us on the basket of stocks that we pick with a floor of protection underneath us. So we always have that floor of 0, and that $5,000 option in this economy, in this example, would buy a 19% cap. I don't know if you all can see that. I'm not sure if the people tuning in through the internet can see it, but there's caps with a floor. Now, there's some products there's some index crediting strategies, depending on the carrier, you don't have to take a cap, but you always have the floor. You can do a monthly average, an annual average, a non-capped, NASDAQ, Dow, all the recognizable indices you can choose. Now, here's the negative. Once you choose one or more, you don't have to pick one. You can do more than one at a time. Once you choose, you can't change it for that 12 months. So it gets a little boring, right? Because we have clients all the time, and you can tell who they are that really like getting up and pulling up their account online. They're like, can you give me the password to log in to see how things are going? Yeah, but you're not going to be able to see anything because the option was traded on a year, which means they can't determine what happened until the 12-month segment has ran its course. And once that's ran, then you're going to know what you made or did not make, but not lose, right? So in 2008, think about the lock-in and reset. Think how powerful this is. When everybody else went from 1,100 to 650, our clients started their gain from 650. Everybody else had to get back to 1,100 before they got to see any gain. And that's been a constant struggle till we, broke over 1,500, now we're over 1,600. I mean, the S&P is on fire. The Dow is on fire. Yes?
I have a question. Are you saying they're buying a call for 12 months out? Why aren't they buying maybe a 3-month call and then in that, then another 3 months, and then another 3 months? Are they just buying like a 12-month call?
You can do it. Yes, the answer is yes, mainly for the name of the cost of what that option is. And you do have the opportunity to pick a monthly average, not just annual. Traditionally, if you look at which is the one that's outperformed all the others, it's the annual. Because what happens is, there could be a lot of volatility in and out of that 12 months, right? All you care about, which Paul will talk about here in a second, you just care about with where your index started, with where your index finished. Provided it's higher, you're going to get the interest credited to your account, which you'll see in just a second, if there's a gain. If there's a loss, you can't exercise the option. It's an institutional call option. Institution means they cut out all the middlemen, and by owning a company like PIMCO, right, literally owning PIMCO, you become the second largest options trader in the world with a huge amount of efficiency, which is what Paul's going to talk about, where you can create some pretty amazing options. Like, as an example, he'll talk to you about one that's called the trigger option. And the trigger option says that if the S&P is 0 or any gain, you get credited 9%. So for those of you that say, well, gosh, Ron and I were talking about this with a client. Well, the markets really ran, so what about the client that may be concerned about linking their money, to, let's say, to an index that's already ran pretty well with the feeling that the shoe could drop? Okay, well, then link to the trigger index. Because as long as the market, in that example, does anything, it could do 0, it could do 0.1%, you're credited 9. But you only have the ability to do that if you've got that large of an efficiency of being the most dynamic money managers, right? Third largest insurance company, third largest money manager, and own PIMCO. That creates a huge amount of trading efficiency. So watch what happens. Question, what happens if interest rates rise? How many of you believe this gets worse if interest rates go up? How many of you believe that this gets better when interest rates go up? You would be correct. It gets better. Why? Watch. Does anybody remember when 7% 30-year fixed interest rates actually sounded low? Right? So watch. Let's say we only need 90,000 of the insurance company only needs 90 of the 100,000 deposit to put into the general portfolio to grow it back to 100, because now we're getting 10.7, not 5.7. You'd say, oh, well, golly, that's outrageous. I mean, when are we going to see those days? I don't know. As soon as 3.5% 30-year fixed mortgages goes back to 7. And at some point, I would tell you, I think that's coming within the next 5 years. Maybe 3, who knows? But watch what happens. Now, instead of 5% being shared, let's say you came in and we were doing a review, or maybe you're traveling, and a lot of our clients will do this virtually with them, because many of our clients are out of state. And they'll say, hey, this is our review. So unlike a CD, that if you don't change the allocation choice, it rolls over to the same allocation choice you had before. So that's how important it is. And I want to stress this really, really well right now. If you just put this on a shelf, picked the S&P 500, and went away for the last 10 years, you'd have done about 7.2%. Okay? If we would have changed crediting strategies a handful of times in the last 10 to 12 years, you'd have done 9.6%. That's why it's imperative that this is why we're very selective of the clients we'll take on. It's not because we're trying to be cocky or anything else. It's just some people, they don't make this a priority, which is why 40% of people have no money in retirement, which is why the average person in their 50s has saved $29,000, right? So this is why, again, you're not certain people's audience. The people that really want to protect their money from taxes, inflation, market loss, and economic uncertainty show up 15, 20 minutes a year. It's not a big commitment on your part on the anniversary of your contract to say, hey, guess what? We've had a lot of inflation. You want to just link to 10% this year? What, are you saying a bird in hand's better than chasing two in the bush? Well, it's your call. It's your temperament of risk. If your temperament of risk is to say, I'll take the 10% for the next 12 months because who knows what's going to happen, that's your call. But watch what happens. What did you give up? Now we have an options budget of $10,000, and that $10,000 may now get us a cap as high as 30%. So I'm asked this all the time. What would you do? Here's what I'd do. I'd link half of it to the 10%, and I'd link half of it to the index. That way I created, if it's 10, I created 5% as a man-made floor under the whole thing. Because I don't want to shoot myself in the foot. Just because there's higher inflation doesn't mean that companies aren't profitable, right? 1980, as Carter was kind of making his way out, the S&P did almost 24%. Okay? Now, I know that interest rates were 18, right? But we still outfoxed inflation. If you've heard me talk about this on my radio shows, this is how you outfox inflation. You link to those things that inflate, right? Rates and returns are relative to one another, right? When mortgage rates goes down, do the rates that the banks pay us go down? When interest rates go up, do the rates that the banks pay us go up? This is how simple this is. Here's how it looks. We know when you use a house of straw, it can obviously teeter on destruction. That's investing, because we have no idea where these indices are going to go. Not only do we not know where they're going to go, admittedly, we don't know which one's going to perform the best. Paul will talk to you about how you can actually have 4 in 1. Talk about hedging your bet, right? So we don't know if it's blue chips, small caps, international bonds. Now watch, versus indexing, where now we can put our money in the house of bricks, and it never leaves here. This is the thing that confuses people. So like, when does Wall Street get my money? They don't get your money. There's an option being traded on your behalf on your money, but only the option's being sent to Wall Street if they exercise it. So watch. Now we index. We pick our basket or baskets. We link to the indice or indices we choose. And when there's a gain, we get up to the gain, provided there's a gain. If there's not a gain, or the market never makes zero. So if there's a loss, they can't exercise the option, so your principal stayed. But if there's a gain up to the cap, it's credited back as the option's exercised, and it's credited back into your accumulation value. That's really how simple it is. Out of curiosity, is it a lot simpler than what you thought it was before you came in here? It's just as a show of hands. Simpler? How many of you now think it's way more complex than what you thought it was? How many don't care? Sincerely, I've had a couple people that we've met with said, look, I don't care. I just know that if this company owns a company the size of PIMCO, they've got to know what they're doing, so just have it do for me what it does for you. I'm not saying that needs to be everybody's attitude, but it's important for us to make sure that you understand. See, we don't spend time in our meetings, in our reviews, educating. We strategize in that meeting, right? In many cases, people become a bigger possibility thinker in these strategies, especially when you realize how you can use the same dollar to do more than one job. So now it may be, hey, here's how I want to help my granddaughter's college. Hey, here's an opportunity for I have one client that takes her granddaughter on every grandchild she takes on an individual cruise, right? We designed a cruise retirement insurance contract for her. She has 17 grandchildren. Now, they all haven't graduated yet. Right? She'd be pretty old if she had 17 graduating grandchildren because they're spread out amongst ages. But there's some really unique things you can do. You can buy a business. You can put money into your company. We have a radiologist that bought an MRI machine. Especially when you realize if you're a business owner or have an entity from a business you used to have, how you can run things through this strategy and actually deduct the cost of the interest that the insurance company charges you for borrowing their money. You'll see that in a moment, too. Now, let's talk about inflation. Does anybody remember their first car? Can you kind of like just mentally go there? What about your first house? Okay? Now, shift with me. Think of your last car. And think of your last home. Okay? Out of curiosity, for how many of you is that at least a 10 times multiple? Yeah, right? I had one guy say, I said, yeah, maybe it was a $3,500 car, and then your last car was $35,000. He goes, $3,500? My first car was $350, and it was held together by a bungee cord. So whatever your first car was your first car, right? And whatever the last one was your last one. But that tells you how the cost of living is going to double, right? So let's take an example that I'm going to walk you through. $6,000 a month. We want to know, when we meet with someone in our Wealth Building Blueprint meeting, we want to know, what is your LI number? LI stands for Lifestyle Income Number, meaning gas, groceries, green fees, Bob Carr tickets, paying your utilities, paying DirecTV, everything that it takes, right? And as a round number, normally the person in the family that keeps a checkbook can come darn close to that round number. And let's say your number is $6,000 a month. Look, we've got people that number is $1,000 a month. We have people that number is $25,000 a month. It's all relative, right? But watch the example. Core inflation we talked about, right? So if we back in food and energy into inflation calculation, what would you guess actual inflation rates to be?
10% to 14%.
I'd say, truth be told, especially if you consume things because you actually have a good income, likely, definitely double digit. But let's just say, just as a median, simple, maybe even less median, just call it average, 6% has been the consensus. World inflation, if that's even truthfully reflected, has been about 5.8. But here's the gorilla in the room. See, there's a difference between goods inflation and service inflation. See, we consume goods before we retire, and we consume more services once we have retired. Do you know what service inflation has been for the last 15 years? Over 7.5%. So let's just go with 6 to keep it simple. Have you heard of the rule of 72s? Okay, so let's say if we take 6 into 72, that number's going to double what to what? What is that going to go to? 12, right? 12 is the number. That means if we live on $6,000 a month today and inflation is 6, it's going to take us $12,000 a month 12 years from today to spend like $6,000 a month does today. And this is the thing I would tell you that is the crying shame of when we sit with people that talk about having a long-term relationship with their financial advisor. They've never had this discussion. Well, they talked about I could live off of 70% of what I made. Really? Let's talk about that. There's some advanced designations that I've entertained myself with in this industry, because again, no one's teaching this in continuing education, I can assure you that. In fact, most of the state folks don't even understand what it is that they actually regulate, unfortunately. If you can imagine that. Doesn't that sound bizarre? Some of you don't find funny my sarcasm or haven't picked up on it yet. As a result of that, that stat was only meant to be true for the first year that you were retired. Now, that's nowhere in this, that's small print, that's fine print. That's nowhere on the internet calculations of know your number or pull up this website and back into your number. Because what's it always say? Pick 70, 80, 85% of what you used to live on, plug in what you think Social Security is going to be or what it is, and then here's your number. That number is only ever going to support you if there's never inflation. And I can assure you, inflation is coming, and it is coming quick. Right? You can't buy $85 billion a month with money you don't have. And right? Margaret Thatcher's quote, right? Eventually you run out of spending other people's money. Right? The great Margaret Thatcher. What a loss in losing her. Because she told it the way it was. So, it's reverse engineering. Remember I showed you in that middle world the retirement insurance contract? This is what we reverse engineer model into. We say, look, what are the least amount of assets needed after you have your cash reserves to reverse engineer into determining how much is needed in this unique savings vehicle so that the income can go up and up and up to adapt to inflation based upon how long you think you're going to live and how high you think inflation is going to go. And then we can calculate that and say, okay, that means you need to put $300,000 in here. For some of you, it may be $800,000. For some of you, we've done these for $5 million. We've done them for $50,000. It's all relative to you. You know what your lifestyle number is, and if you don't, which I have to be honest, most of our clients do, but several of them still don't. Because especially those that just transition from working to retiring, it's fascinating how you look back and you're like, oh, I can't believe I'm still paying for that. We're still paying for that? That's deducted out of my account. I probably have that conversation once a week in my office. I'm like, wow, things must be good that you got stuff being deducted. You don't even know that you're still paying for it. But we just get busy, right? Time and attention. In fact, let's do this. Let's talk about time and attention. Can we pass these out, guys, real fast? I can tell I'm losing the group here, and I want to get them actively involved again. So I'm going to pass the exercise out for you. And what I'm going to ask you to do is not turn this face up. I want you to keep it face down like this, if you would, okay? And this is going to teach you quite a bit of what I've been teaching you. And I want to preface this, too, by the way, the count on the basketballs. Who thinks they had the right number of the number of times the team in the white passed the basketball? Does anybody even remember that we did the exercise? How many times did you have? 15? 16 is the correct answer. Now, keep this face down, because here, how predictable, still in almost 15 years, no one's gotten that right. This one, in the last 10 years, nobody's gotten right. So keep it down, please. I know there's always a handful of overachievers in the room that are already like trying to hold it up to the light and see what they can. Okay, just keep it face down, please. Okay? Now, simple instructions. In a minute, less than a minute actually, figure of speech, I'm going to ask you in just a few seconds to take what is being held in front of you face down, right? And I'm going to, not yet, I'm going to ask you to turn it over, and then I'm going to ask you to do one simple thing. I'm going to ask you to quickly memorize what's on this piece of paper. Now, here's the rules, okay? Neil has volunteered his Mini Cooper as the prize winner if anyone can get this right, and he feels pretty safe that he'll be driving home this afternoon to his home, okay? It's a cool little car. It's red. It's really cool. So I want to motivate you here. You need to put them in order. So when I say go, not yet, my gosh, and there's people like this. We can show you how to buy a Mini Cooper out of your retirement insurance contract. It's an economical car. Bear with me. Not only putting it in order, all right, but then putting it back. So basically, when you read it in order, I'm going to then say flip it back over, and then I need you to write it. So to win, it's got to be in the order of what you read. Go. 5, 4, 3. Someone always cheats. 2, 1. Please turn it back over. Please turn it back over. Some of you are, I am turning it over. Not in slow motion. And now please write what you read in order. Who thinks they have them all right? Oh, I love it. 1 already. 2. Sonny, you can't participate in this.
My first car was a Mini Cooper, dude. 1977.
We had a client here Thursday that I've probably taught this to 5 times. And he got it wrong. So I won't, he'll go unnamed. Everybody got it? Who's frustrated right now? I'm just kind of curious. Like, what does this have to do with anything that this guy's trying to teach me right now, right? Be honest. Suspend your disbelief. Who thinks they have them all right? You feel you have them all right. Give us just the first one.
Peas in a pod.
Okay. Who has something different than that? You, sir.
2 peas in a pod.
Okay. Who has the second one? Yes.
Paris in the spring.
Okay. Who has the third one? Yes.
Pop goes the weasel.
Okay. What did you have?
Pop goes the weasel.
What did you have for the first one?
Paris in the spring and 2 peas in a pod.
2 peas in a or 2 peas in a pod? The streak's alive. Turn them over, folks. Man, you had me very worried. So read the first one. Read the first one out loud.
2 peas in a pod.
2 peas in a pod. Paris in the spring. Pop goes the weasel. Did anybody have that?
I thought it was a typo.
Oh, you're already trying to spell check us, huh?
I was writing fast and I forgot to write the second A.
Oh, wait a second. I want to give you another great life lesson before you leave here. This one hit me this morning when I woke up thinking, what's the greatest lessons I can leave with you guys today? And it's called Above the Line. Now, this one is priceless because we use this with our boys. So this one you're going to want to write down. So above the line is accountability and responsibility. Above the line. This is where our country is in shambles right now. And below the line is blame, shame, and justification. So what I just heard somebody say was, well, because I was writing so fast, I didn't get it right. Because these people didn't save enough for retirement, you should be taxed more so you can make up for their retirement. Right? So think about it. We do this with our boys now. It's priceless for children, grandchildren, even spouses, because my wife does this to me regularly. All you have to do is go like this. And all that means is, are you playing above the line or are you actually playing below the line, right? Below the line, we all can go there, right? We used to do in our family, it was $1. You had to give up $1 for every time you went below the line, and then we donated it to our favorite charity, Nations of Coaches. It works. You know, it gets pretty painful when your kid has to go into his little room and pull out of his drawer the few little dollars that he has and bring them in. You're right, Dad, I was below. It works. See, this is the problem with the whole country. Blame, shame, justification. It's getting worse before it gets better. All we need is accountability and responsibility, right? This is being responsible, right? We pay our fair share. We more than pay our fair share, especially when only 47% of us that are counted in the calculation, right? The fuzzy math of unemployment rates going down is the most absurd thing I've ever seen in my life. You know, when you have to count a smaller number, because there's so many that dropped out, the actual number has been going up, it's not been going down. But can you imagine those people that just sit there and go, wow, economy's getting really a lot better. Unemployment's really almost down to 7.5%. As if 7.5% unemployment's good, right? Think about this. You realize people miss it. Why? Why do we miss it? Time and attention. What I love about events like this, especially when we get to teach them on Saturday, I know you got things to do. We all have things to do. But what's kind of cool about where you are at this moment is you can tell where somebody's at by where they're at, right? You can tell by where somebody's at by where they're at. And to be present is unheard of today, right? Go to Panera. I watched two girls at Panera sit there at the same table, never communicated. They were this. I mean, they never talked. As I sat down, they weren't talking. As I got up, they weren't talking. And eventually they left. And one went out the back door, one out the front door. This is where people aren't present anymore, right?
They were texting each other, though.
Yeah. Amazing. So inflation's a big deal, right? Here's the gorilla in the room. It's projected most of us in this room will spend more years not working than the number of years that we worked. And that's what screwed this whole thing up. Is FDR had this great idea to offer this thing called Social Security, right? What a great campaign program, right? When you were going to pay a benefit out by the time everyone else would have been dead, right? You'll see that. I mean, this is most people retired at 60 and were dead by 61, right? In many cases, benefits weren't going to be paid out beyond 61 or until after 61. And then what happened? Corporations in the 30s and 40s, what did? They rolled out the defined benefit program. It's in my book. Right? The Personal Protected Pension Plan, I write about it in my book. What do? They said, hey, this great idea to keep Ray on with us and committed. The longer he's here, a higher percentage of his pension benefit that he's going to get. Right? Fascinating. What did Henry Ford create? Nope. What did he create? Nope. He created the weekend. People got paid extra to take off on Friday, okay, so that they could drive the product that he was selling, right? Fascinating. Again, all this stuff's right in front of us. We know Henry Ford for what car? Ford. If you look at what Henry Ford created, he actually created the weekend because that's what kept people at his company. Hey, here's what we're going to do. The very product you're making, I want you to sport it, right? You've heard the phrase, go sport it. And as you sport it, what's that going to do to demand? It's going to drive it. And how many people want to come to work at Ford that can get a great pension and go sport it and have their time on the weekend? That's what Henry Ford created. But guess what? I could ask 1,000 people that question. They would all give the same answer that you and I would likely give, right? The Model T, the assembly line, jobs. You want to know what real inflation is? You create an index called the BMI, the Big Mac Index. Okay? This is true. This is the CPI number from 1986, that inflation has supposedly only gone up 110%, but fascinating, the Big Mac since 86 has gone up 173%. That's real inflation. This is what people are buying. Billions served daily, or whatever the phrase is, right? I believe this is a key video that we'll hit the lights for. Am I correct on that, Devin? Okay. Here's what as we transition, we're almost done because you don't want to miss what I have. We're almost finished. This is arguably the best commercial I've ever seen as it relates to putting into perspective that inflation protection rider, in particular to the fact, and I hope you all caught it because we covered a lot of numbers in a very short period of time with all the different schematics we've been through. 187,000 over 20 years grew to 410,000. Okay, I mean, that's really, really powerful. You don't pay for that unless you want to trigger that. Now, does it mean you start out at 187? Because I don't want people to miss this. No, you may have had to start out at maybe 168,000, and then it grew and it grew. So you sacrifice early to get a lot more later. Now, again, I know that's not necessarily how our countries ran, right? Let's just print more money would be their perspective. Here, we're actually tightening our belt and saying, okay, let's get by with this, and we can grow it to more later. This is going to put that in perspective. And the question you need to ask yourself is this, as I get ready to play this. Who is the oldest person you know? Okay? The oldest person you know. The gentleman's pointing at himself. Oldest person that you know. I love it. We're almost done. I can tell people are starting to go stir crazy here. But watch this. This will play in just a few seconds, and I think you'll appreciate this. Oh, I'm going to go through it very quickly then. I want to get you guys to this commercial because I want to catch us up. You can leave it there. We're going to transition. Insurance is costly. What are the charges? So we contrasted this before I play the commercial. We contrasted, let's say, the 1.5% mutual fund average cost to the design that I'm showing you here, okay? And we assumed a few things. We assumed that the stock market never lost and always made 7, okay? And there were no taxes, which is very unfair to compare, okay? Now, notice our assets under management of $500,000 at 1.5% over this 30-year period, we paid fees of $557,000, more than the amount we started with, in the lowest average mutual fund cost. And we grew our money to $2.4 million, assuming no losses and no taxes. Contrast that with special designed, what we call Survivor Index Universal Life, which we're not going to get time to go through today. And that internal cost over the 30 years was $206,000, not $557,000, and we grew the money to $2.7. So look at the difference. $206 versus $557. So when someone says to you, oh, that life insurance stuff, that's really costly, not the kind that you know about, far less of a cost than what everybody else is paying. And unfortunately, until this year, it never had to be disclosed, all the fees and expenses in these 401ks and brokerage accounts. For the first time, because of what happened to the 401k in 2008, individuals lobbied very hard and raised money through nonprofit organizations to force the hand of the government to reflect the true costs. Now, in fairness, you'd say, well, gosh, yours grew to 2.7 and this one 2.4. Yeah, but watch. We used an index that only made 5, but we got 140% of it. That's a unique index, which means it credited 7. And took on 7 in assets under management and assumed no losses and no taxes, which is not going to happen, and still outperformed over that 30-year period. This was a succession plan that we did for a dental group we were asked to come in and present to one of our clients in one of the oldest dental societies in Florida, arguably in the country. And the father was 60, the son was 35, and it's a great way to do a joint contract where you can do this with it used to be you had to be a spouse. Now it could be a child, a grandchild, etc. And it was a way to design about $60,000 of income to retire the father, and then the son to come in and buy out the father to take over his dental practice. We have quite a few dentists and quite a few medical doctors as clients that use this as a succession tool. So this is the video. All right, think of it. The oldest person that you know, think about the age of that person.
65 years old. When that became the official retirement age, back when my dad was a kid, life expectancy was about 61. Not much of a retirement, huh? Luckily, things have changed. To see how, we went out and asked people a simple question. How old is the oldest person you've known?
The oldest person I really know is probably my grandfather. He's 93.
94.
104 years old.
Then we gave them each a sticker and had them show us. Soon we learned a lot of us have known someone who's lived well into their 90s. And that's a great thing. But even though we're living longer, one thing that hasn't changed, the official retirement age. The question is, how do you make sure you have the money you need to enjoy all of these years?
Now, I don't know who the oldest person is that you know, but we've had people in our office who 106, have family 106, 107. There was a lady in Cleveland that died not long ago. She lived to be 118. Check this out. Life is surprisingly healthy at age 100. Now watch this. This puts it in perspective. Meet Sarah. She's 118. Okay? Now this one is the one that killed me. Meet the daughter, Kitty, at 95. Okay? Meet the grandson, Bob, at 73. Meet the great-granddaughter at 49. I love Bradley here. Meet Christina, the great-great-granddaughter at 27. And look at little Bradley with the bird. Meet Bradley, the great-great-great-grandson, age 3. Now, this was out of the New York Times in 2001. So people are living longer and longer. Debbie on our team, her husband leases property to snowbirds, and a guy calls up and says, "Can you help me with a stupid rental car?" And John doesn't help people with rental cars. He said, "Why? What's wrong?" He goes, "I'm 106. My wife's 104. We want to come down there for a month. We want your place, but we need a rental car, and these idiots won't lease me one or rent me one." So John scurried around and helped him find a $95 a day rental car company to give this guy a car for a couple months. And strange enough, the gentleman passed away when he was here, if I recall, right after he left here and head back to Chicago. People are living longer and longer and longer, right? And that's this trap. And here's one you don't want to miss leaving with. Here's the hard stats. No one ever plans on getting sick, but our own IRS, as horrible as they can be in their accounting, says under Obamacare that the average family will spend $20,000 a year on health care. The average family. I think our HSA for our family right now is about $500 a month. $6,000, not 20. People got to prepare for this. He said HIT, right? Health insurance, inflation, and taxes. I love that, HIT. Long-term care, I just review these for clients. I don't have a health license, but I know people that know long-term care very well. And as I'm looking at these different strategies, be careful when you get called by the company about how you can add to your elimination period and cut your premiums. It's because they've really done a horrible job in their actuarial projections. Make sure you've got a cost of living adjustment rider, et cetera. Many of these contracts that I review, the daily benefit's $150. The daily benefit today is about $254. So they're $100 a day underwater. That's right now running $7,000 a month in today's economy. And then lastly, the Employee Benefit Research Institute, the lifetime cost forecast for out-of-pocket for health care for a female in 2020 retiring at 65, low-end 156, high-end 357, out-of-pocket, not covered. So that P in TRAP, for our hidden wealth traps, that's a huge deal because it's not always you that's the one that gets sick. If anyone's ever had a family member that's gotten sick, you understand that destroys somebody's life for the number of months and years and time that person's unhealthy. And some of them get healthy and some of them never get healthy. And some people, unfortunately, end up having parents that aren't well and children that aren't well, and that's even worse. And we're out of pocket on those things as well. So the retirement planning puzzle, you guys actually, I think, was everybody given one of these? I'm going to make this quick. The puzzle is, number one, die too soon, become ill, or live too long. So pull that out. Think about this. If we die too soon, we need more of a survivor indexed universal life strategy. So there's ways we can design this that if the income's on you and then you die, the income transfers to your spouse or your son or your grandson even after you die, especially if you die too soon. ABRs, accelerated benefit riders. If you become ill, I mentioned this as we started, if you needed to exercise, let's say something to take care of a chronic illness, which would be not being able to perform 2 of the 6 daily living activities, things that you and I today take for granted like you can't even imagine, like getting out of bed, right? Eating, bathing, toileting, all the things that we take for granted. When those things fail you, at least 2 of them, there's ways you can use your retirement insurance contract to not spend down your wealth. And then lastly, live too long, which we just addressed. Goodness gracious, if you notice where all those dots were going up in that Prudential commercial, right, to give them credit for the commercial, most of those were in the 90s. Now, that's why we need what's called a lifetime income benefit rider. Some of the other contracts that our family has, and the gentleman that couldn't be here today that served the 2 tours in the armed services in infantry, this is a big one. This is the contract that allows you to turn on that income, in my example, that $60,000, and if the whole accumulation value in that insurance company went to 0, they're still on the hook. Not an annuity. Operates very similar to a lifetime income benefit to an annuity, but also has an inflation adjustment rider associated where the income can go up. That's how you make sure that you put the pieces to the puzzle together. Are the insurance companies safe? Legal reserve insurance companies, reinsurance. Insurance companies believe in what they do, right? So if they don't want to take all the risk, there's other insurance companies that will come in and buy part of that risk, and most of the time you and I don't even know it. And then there's State Department guarantee funds, so if the whole world went to heck in a handbasket, right, an A-rated carrier is going to have more than $1 on reserve for every dollar that it has exposure to in order to meet its reserve requirements, which means if this thing goes down, your money was lost a long time before this one, okay? But if it is, the state of Florida, if you want to know the facts, it's $100,000 of cash value, $300,000 of death benefit, even if all those levels of protection are broken through. Never has there been a legal reserve insurance company ever, life insurance company, ever to fail meeting its financial obligations. Never. You know some of these people, J.C. Penney, to get through payroll and start the catalog, although his brother wanted to go into alcohol sales, he decided to start the catalog. Disney, under a fictitious name, acquired Disneyland using these strategies that I'm teaching you. In other words, used life insurance. And then his first gubernatorial campaign, McCain used his max-funded permanent cash value policy to also fund that campaign. So that your imagination can run wild with however you choose to use this. Why has the IRS not changed the law? Two main reasons. Politicians want to get reelected, and they lobby hard for that reelection, which is where this whole thing was birthed under what's called bank-owned life insurance and corporate-owned life insurance. Bank of America, 70,000 employees, goes to their congressman and says, wow, we've got 70,000 term policies. This is a big negative on our balance sheet, on the liability side. Surely we can make this stuff have a cash value, reposition it to the asset side of our balance sheet, and make our price-to-earning ratios look better, and hallelujah, we all get to retire with golden toilet seats. Right? That's how it came about. Now, the other big one was consumption tax. If you and I have 50% to 100% higher net spendable income in retirement, we're going to spend it. It may not be on us, but we're going to spend it. We're going to spend it on our grandchildren. The one client that was here Thursday, 17 grandkids, no kidding, that we called her the gallivanting granny. The fact she was even in town surprises me because her kids are spread out all over Utah and Atlanta and everywhere else. But people consume. And the second reason that I don't think they're going to change it altogether, because I can't promise that they won't, or at least not grandfather people in that were grandfathered before, is the fact that inheritances are blown, which is why you want to protect that intentionality inside of your trust to pass your legacy with proper instructions from heaven, not just all of a sudden a death benefit going to a great-granddaughter who says, wow, let's go buy the car I could never afford or buy the house on the beach. But the IRS is counting on that. Because guess what? All lottery winners and all inheritances, 85% of them are blown within 24 months of receipt. See, if you can't respect what it took to earn the money, you're never going to be able to respect what it takes to spend the money, right? So, retirement insurance contract. So, don't follow the crowd. This will be our last video. I'm going to give you then just one set of quick instructions, and we're going to be out of here. Good? You don't want to miss this. Who remembers the old candid camera? All right, you'll appreciate this. Let's cut the lights. If we get the volume.
The gentleman in the elevator now is a candid star. These folks who are entering, the man with the white shirt, the lady with the trench coat, and subsequently one other member of our staff, will face the rear. And you'll see how this man in the trench coat tries to maintain his individuality, but little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. Now we'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups before. Here's a fella with his hat on in the elevator. First he makes a full turn to the rear, and Charlie closes the door. A moment later, we'll open the door. Everybody's changed positions. Now we'll see if we can use group pressure for some good. Now, in a moment, on Charlie's signal, everybody turns forward. There it is. Notice they take off their hats. And now, do you think we could reverse the procedure? Watch.
Oh, wow, hit those lights. Okay, the thing I want to leave you with, right? And it was kind of a sad visual to see the young man watching the older people, because that's what a lot of people do, right? It's too easy to follow these things. In fact, to use kind of the instructions on the outside of the box, it's time, as Time Magazine said, to retire the 401k in the IRA, right? To rip up the tickets, right? And the reality of ripping those tickets up is it's going to be too easy based on human instinct to continue to follow the crowd, because it's just the easier thing to do. In fact, our pastor in service last week said, you know what? And he used the out-of-the-box analogy. He said, you know, people just tend to always do what's comfortable, always tend to just do what they see somebody else do. And I thought that was a great caption in that example to show you how, and my wife actually did this at a speaking event last fall, and we stepped into the elevator and we faced the back of the elevator. And I got to tell you, it was a very awkward scenario, but if you get a chance to do that, do it, because it freaks people out, right? Because they're going like, is the door going to open behind me, or how is this going to work, right? And what you've learned today, what you've taken today, and I hope, did anybody take some good notes? Hope you took good notes. In fact, you've got your notes section there. If you guys want to open this up, I'm going to ask for your help. This Worry-Free Wealth Workshop, if you don't do anything else for us, would you tell us what your biggest insight was and leave this with us? This isn't to try to sell your name and take advantage of your information. We really want to know what your insight was, because I'm writing a book from this. And what I'd really like to ask, for those of you that are willing to do it, is just get your 2 cents on like a little 2-minute, you know, what was your feedback from your experience today, especially people that aren't our clients, just to get what your insights are. But as this unknown quote comes, all are presented opportunities. Many recognize it. Some respond to it, and an elite few take advantage of it. Today's Saturday. Here's our workshop form. We really want to know, okay, so that you understand our process. What was your top insight? Now, if you had more than one, tell us that. And on the back, what didn't you like about this experience? Just write it right on the back. Please do that. What didn't you like? And now, here's the deal, though. Don't tell me you didn't like the Danishes. Don't tell me you didn't like the air conditioner on, because some of you are shivering right now. I knew that was coming. Sorry, let me preface that. Constructively, what you didn't like about, things we said, who we said it about, how we said it, what could we have done to improve. But your top insight on the front or more, and your dislikes or things you constructively think we can do better on the back. Now, here's our process so that you understand how we work. We're paid directly by the insurance company. And in our process, so that you're aware, we've got your level of education to right here today, okay? And as I shared with you, you know 99% more than people that hold their shingle out that actually try to sell this, okay? You've been educated to here. Now, how we typically work is when we start putting together a formula, we typically would charge somebody $1,000 to do that. Why? A, we want to make sure that we have their time and attention, and this is a focus for them, number two, but also so we can get paid for our time, because we don't get paid until we place that contract, which means we're taking good faith that you're going to do a contract which you're not committed to do, okay? Now, as a result of that, we came together and said, you know what? Where's the biggest downside to our system? Our biggest downside to our system is people's education's here, and then what happens over time? It dissipates, right? Here's the second rule of the rule of 72. Are you ready for it? Because you're going to want to remember this one. The second rule of 72 says this: whatever you've learned that you don't continue to learn more about within 72 hours is gone forever. Busy, time, attention, this came up, that came up. We get it. It's below the line. It's blame, shame, justification. But the reality is we have other things we make as a priority in place of other things we don't make as a priority. So here's what we've done. We actually have waived our $1,000 plan design investment for those that have their calendar, know when they would want to meet, to actually build, not a committed meeting to any certain amount of assets, but want to book something to come in and discuss it, because our calendar usually fills up about 2 weeks in advance. That's about what it runs, just to give you an idea. And we limit to meeting with about 4 people a week because of how much is involved with putting together a plan. So we waive that so that and here's the selfishness of why we do that. Because if we can get your education from here, especially with me being willing to sign a book for those of you that sign up so you can take the book, read it before you would come in, now when you come in, now we have a conversation up here. Now it's not about, now, what was that and how did that work and go over that. No, hey, here's the situation. I've got 2 grandkids and I'm trying to do this and I need the income to be this much by this year and I got this option that I could take with my company as a lump sum or not, and it's a strategic strategy session to build a wealth building blueprint so that you can have some direction, because at that point, we have to get you medically underwritten. You're not committing to anything other than going through a medical exam to get an idea of what kind of a plan can be approved for you. And then when those results come back, then you final the blueprint. And that's the only commitment, is when you say, hey, Chuck, I know we got approved for 5,000 square feet, but we're really only comfortable building 3. Hey, good news, we only needed 3,000 square feet to build the home that you were looking for. Okay, great. And only until then, that being decided, is when we actually get paid. Because everything we showed you today, we're paid directly from the insurance company. We don't have to charge you. There's not a management fee for us. There's not an annual review fee for us. And all we ask of you is to make sure that you hold us and we hold you accountable every year on the anniversary of that contract to make sure that we continue to build upon what we built from the year before. So that's how simple we've made it. So as you leave here today, think of this. Our team's in the back. If you have questions, make sure you write who invited you here, right? We have about 4, total 5 with me, authorized wealth architects. Know how you got here, right? And as a result of that, if you're genuinely interested in signing up to continue the momentum of your education, to go through our proven process, we didn't just make this process up. This is a process that's proven itself time and time and time again. You get less frustrated as a result of committing to this next meeting and not get there, or not set it within, let's say, the next week or 2, because all that education starts to dissipate. And we looked at it and said, what? It's a win-win for us. Why charge somebody $1,000 if we can maintain that leave here with as an education, hopefully with greater than what you walked in with, as it relates to saving you time, taxes, inflation, market risk, and economic uncertainty. Lastly, I'd like to thank Paul coming all the way in. I'd like to thank my team for coming and putting this whole thing together. I got to tell you, even though we may have only had about 100 people between live and internet, it takes a lot of work to put something like this together. So would you mind to give my team just a nice, warm welcome, round of applause, excuse me. That's it, folks. We wanted to get you out so you weren't totally hungry. We'll be happy to stick around and answer questions in the back. If you have more individual questions, let us know that too. If you know you want to meet, let us know, because it's on a first-come, first-serve. And we had quite a few people sign up Thursday, so let us know. If you don't know your calendar, put on there, here's the number to call Monday, the best time to reach me, and then I'll have my calendar, and we'll coordinate that with you as well. Thank you for your time and your attention.